Samit is a good old-fashioned mid-cap and small-cap stock picker. Over the years, he's had top of the line returns from the mid-cap and small-cap funds that he runs very, very successfully. And he's here to tell us whether it's all okay in the mid-cap world. Samit, it's a pleasure having you on the show today. Tell us, how are you feeling about mid-caps and small-caps today? Because we've had a great run-up. People have made a lot of money in the last 1 year, but now there are concerns with all that is happening in the environment, whether stocks have run ahead of themselves. Are you feeling comfortable with valuations in the universe that you handle?
Right. No, you're right, Udayan. It's the valuations, at least in terms of the most common parameters that we follow, P multiple are high for sure. There is no question about it. But, I have presented some analysis in my newsletter where I think there are few parameters which I think are much more comforting. Few of those are, if you look at the price to book ratio, it's still at around 3.6, whether you look at the large cap or the small cap, mid caps, which is near the average of, the market over the last 30 years, or if you look at last 40 years. And generally, whenever, price to book is a more relevant metric because it is much less volatile in nature, and it has much higher predictive power over the next, in the long run, whether it's a 5 to 10 years, it's much more correlated. So if you look at 10-year return, it's almost the R square, what you call, the correlation is almost 75%, which is pretty decent, right? But in the short run, the P multiple or price to book is just a random noise. There is no correlation at all. So just because the markets have gone up in the last year and a half, doesn't mean that it's not going to continue going up, because just looking at the statistics, there is nothing to prove any of that. What gives me comfort is also that if you look at the cash flow generation, it is at the highest level that we have seen. Generally at the peak of the market, the cash flow drops. The cash flow from operations typically goes down because the receivables increase, the credit cycle or the credit terms that a company provides to the customer also, goes up and it's loose, which is not the case right now. So the debt to equity ratio, typically the debt to equity ratio also goes up because there is a huge, capex boom that happens towards the end of any economic cycle, which is today at the lowest level that we have seen in the last 30-40 years, right? So when you look at the fundamentals of the economy, they seem more towards the bottom of the cycle. But yes, there is a huge divergence between the valuation seems to be more towards the top of the cycle. But again, as I said, when you look at the price to book or whether it's enterprise value to cash flow from operations ratio, they're more towards the average. And that's where I think, I'm comfortable, which wasn't the case in 2017. The price to book, whether it's in 2011 or 2007, the price to book you would see had gone up significantly higher. Even in the early 1990s, 1990 to 1993, the price to book had gone to 10 times. In 2007, the price to book was about six times. Today, it's at 3.6 times, which is reasonable enough.
Right. So what's the right way to play it from here on, Samit? I mean, that's the big question. Because a lot of people are drawing parallels with this cycle which is playing out to 2003 to 2007. Do you see it that way? Because then the right way to play it would be to play the big capex plays, to play the big corporate banks because of a new credit cycle unfolding. Or do you think this one is different and one should not get trapped into thinking it's the 2003, 2007 story playing again?
Right. No, you're exactly right. I think 2002, 2003 was the bottom of the economic cycle, and a lot of ratios seem similar to that. But the valuations in 2002, 2003 were probably 1/3 of what we see today. So that's a big difference. So a lot of the growth is already priced into the markets. And then again, 2003, 2007 was sort of a once in a century kind of a boom cycle, where all cylinders were firing across, whether it was China going for a huge capex boom across the world. There were capex housing cycle which had picked up. Same thing was in India. India went through a huge infrastructure boom, real estate boom, and a big capex cycle where the financial sort of lending policies were pretty loose, and they continued. Today I think betting on similar things repeating, because we all know how sort of leveraged China is, and China doing the same as what they did in that period it seems extremely unlikely. Same thing is with the world. The world is laden with a huge debt, which wasn't the case in 2002, 2003. And India seems to be in a different position because India's leverage, even debt to equity at a GDP level, is pretty reasonable. The corporate debt to equity is below 30% of GDP, which generally used to be 70-80%. China, at the same level would be at 200%. So there is a huge difference. So India, I feel, has a much higher potential of repeating that cycle. Just because of the kind of cash flow that the companies are sitting on, as well as the debt to equity ratio that the company has. So there is a lot of room for them to, the median debt to equity is 0.16 times. So there is a room from going from 0.16 times to their normal level of 0.7, 0.8 times, right? But the same kind of sectors playing out will be very difficult. For example, lending space, the banking space, when the companies themselves have deleveraged, going through pretty rough period last 5 years, they are generating enough cash so that they can do the expansions through internal accruals. So the same ratio that we typically use for lending growth or credit growth of 1.5x or 2x of GDP, it's extremely difficult. I mean, they would be definitely underperforming, over the next cycle. Same thing is with the more cyclical sectors like auto. So you have to be very, very careful. Because you will not have the other wheels like the global wheel or the Chinese wheel to pull up the economy as what it did in that kind of a cycle. So I think this time you have to be very, very selective, just given that the valuations of 3x of what they were in 2002, 2003, there could be a risk if something doesn't play out. You could face a big downside. So you have to bet on sectors where the visibility is extremely high, and irrespective of whether the economic cycle picks up or whether we go through a struggling economy, those sectors should be able to deliver. I think the probability of success where you invest has to be much higher today, rather than just betting on a macro saying that the economy is going to go through a big upcycle. I think that's a very, very risky game.